Money. It's something we all use, yet few truly understand. A fascinating concept, money has served as the lifeblood of civilizations, fueling trade and shaping societies. At its core, money is three things: a medium of exchange, a unit of account, and a store of value. But let's journey back to its inception. In the dawn of human civilization, there was no money as we know it today. People traded goods directly in a system we now call barter. But barter had its limitations, and so our ancestors sought a better alternative. This led to the creation of commodity money, items that had value in themselves as well as value in their use as money. We're talking about things like salt, tea, tobacco, cattle, and shells. But as societies grew more complex, so did their need for a more standardized and portable form of money. Enter precious metals. Gold and silver, being rare, durable, and divisible, were seen as the perfect medium of exchange. They formed the basis for metal coins, which were stamped with their weight and purity, making trade a lot more straightforward. But gold and silver weren't just shiny objects that people fancied. They held a critical position in the global economy for centuries through the gold standard. This monetary system tied the value of a country's currency directly to gold. So for instance, if you had a $10 bill, you could, theoretically, exchange it for $10 worth of gold. This system maintained a sense of stability and trust in the economy, as people knew that their money was backed by something tangible and valuable. Each unit of currency could be exchanged for a fixed amount of gold. This was a defining step in the history of money, setting the stage for the evolution of the financial systems we see today. As we move forward, we'll see how this gold-backed currency paved the way for the rise of the central banking system and the digital currencies of the modern era. In today's digital age, money has become less tangible. It's no longer about physical coins or paper bills. It's more about numbers on a screen. This shift occurred with the rise of the central banking system. Central banks emerged as critical players in the financial landscape, wielding the power to shape economies and influence monetary policy. They are like the puppet masters pulling the strings behind the scenes, directing the flow and value of money within a nation's borders and beyond. Consider the Federal Reserve in the United States or the European Central Bank. These institutions are not just banks in the conventional sense, but are more akin to financial regulators. They control the money supply, set interest rates, and act as lenders of last resort to commercial banks. Their primary function is to ensure economic stability. They do this by controlling inflation and managing the country's currency and credit. By adjusting the volume of money in circulation and the cost of borrowing, central banks can influence spending and investment decisions, thereby affecting economic growth. Central banks also play a significant role in preventing financial crises. When the economy is in trouble, central banks step in as a lender of last resort, providing funds to banks to prevent their collapse. This function was particularly evident during the global financial crisis of 2008, when central banks worldwide pumped trillions of dollars into their economies to prevent a total meltdown. To regulate the economy, central banks use various tools. One such tool is quantitative easing, where they buy government bonds or other financial assets to inject money into the economy. Another tool is open market operations, where they buy and sell government securities in the open market to control the money supply. These tools allow central banks to stimulate the economy during a downturn and cool it down when it's overheating. They can increase or decrease the money supply, lower or raise interest rates, and change reserve requirements for commercial banks. In essence, central banks hold the reins of the economy, guiding it towards growth and stability. They use tools like quantitative easing and open market operations to stimulate or cool down the economy as needed. But the rise of cryptocurrencies has disrupted the traditional financial system. Imagine, if you will, a world where money isn't controlled by a central authority like a government or a bank. This is the world of cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They're not issued by a central authority, and that's what makes them immune to government interference or manipulation. Now, the most well-known of these is Bitcoin, followed closely by Ethereum, but there are thousands of others, each with their own unique features and uses. So how do these cryptocurrencies work? They operate on something called blockchain technology. Think of a blockchain as a public ledger. It's decentralized, distributed across a network of computers or nodes, and it records all transactions made with a particular cryptocurrency. This decentralization is key. It means there's no central point of failure, no single place a hacker can attack to bring the system down. And it also means there's no central authority that can be corrupted or that can abuse its power. Now, what benefits do cryptocurrencies offer? For starters, they provide fast, borderless transactions. You could send Bitcoin to someone on the opposite side of the world, and they'd receive it in minutes. Try doing that with a traditional bank transfer. Plus, the fees for these transactions are typically lower than with traditional banking systems. Cryptocurrencies also offer a level of financial privacy. While all transactions are recorded on the blockchain, they're linked to an anonymous digital address, not your real-world identity. This doesn't mean cryptocurrencies are a haven for illegal activity, as some might suggest. It just means you have the option of keeping your financial business to yourself. Finally, cryptocurrencies provide a degree of financial independence. You're not reliant on banks or governments to manage your money. You have control over your own digital assets. These digital currencies offer financial privacy and independence from traditional banking systems. Cryptocurrencies are not just a new form of money. They're a new way of thinking about and interacting with money, and they're already changing the world. In response, central banks are exploring the concept of central bank digital currencies, or CBDCs. These digital currencies are a new type of money, designed for the digital era we live in. But what exactly are they? Central bank digital currencies are essentially a digital form of a country's fiat currency. They are not a new currency per se, but rather a digital representation of the existing one. Think of them as the digital equivalent of the coins and notes in your wallet. Unlike cryptocurrencies, which operate on decentralized networks, CBDCs would be issued and regulated by the central bank of a country. This centralized control ensures that CBDCs are as stable as traditional fiat currencies, avoiding the extreme price volatility often associated with cryptocurrencies. Now, you might be wondering, how do CBDCs differ from the digital money we already use, like the balances in our bank accounts or the digital payments we make through apps? The key difference lies in the technology. While our current digital money system is based on a decades-old infrastructure, CBDCs would leverage the power of blockchain technology, providing a more efficient and secure way to transact. But why are central banks interested in issuing their own digital currencies? There are several reasons. Firstly, CBDCs could improve the efficiency of payment systems and reduce transaction costs. They could also provide a more inclusive financial system, reaching individuals and businesses that are currently underserved by traditional banking. Furthermore, CBDCs could give central banks more control over the money supply. Today, most of the money in circulation is created by commercial banks when they issue loans. With CBDCs, central banks could directly control the money supply, potentially leading to more effective monetary policy. However, this increased control comes with its own set of challenges. There are concerns about privacy, as CBDCs could potentially allow central banks to track every single transaction. There are also questions about how CBDCs would interact with existing banking systems and what their impact would be on financial stability. In conclusion, CBDCs would offer the benefits of digital transactions while maintaining control over monetary policy. They represent a new frontier in the evolution of money, one that could reshape our financial system in profound ways. CBDCs could revolutionize the way we transact, making payments faster, cheaper, and more secure. This is the optimistic view held by many financial experts. They argue that central bank digital currencies, or CBDCs, will streamline transactions, eliminating the need for intermediaries and reducing the overall cost of transacting. Moreover, with CBDCs, transactions could be completed in real time, offering a level of convenience that traditional banking systems can't match. But, as with any innovation, CBDCs bring their own set of challenges. There are those in the financial community who express concern about the potential risks to privacy. In a world where every transaction is digital and traceable, what does that mean for our personal freedoms? Will our spending habits become an open book for governments and corporations? Further, the rise of CBDCs could lead to an unprecedented concentration of power. If central banks control the issuance and regulation of these digital currencies, they could potentially manipulate the economy on an even larger scale. This raises questions about the balance of power and the role of central authorities in our financial lives. In addition, there's the issue of surveillance. With each transaction logged and traceable, could we be moving towards a society where our every financial move is monitored? These are the questions we must grapple with as we move towards a digital financial future. Yet, despite these concerns, the potential benefits of CBDCs cannot be ignored. They could open up financial services to those currently unbanked, providing a more inclusive financial system. They could also offer a level of security and trust that current cryptocurrencies lack, being backed by central authorities. As we navigate the complexities of the modern financial system, it's essential to understand the role of central banks, the impact of cryptocurrencies, and the potential future of money with CBDCs. Stay tuned to Elite Economics for expert insights, analysis, and discussions on the elite economics of tomorrow. Like, share, and subscribe to our channel for more thought-provoking content on the intersection of finance, technology, and economics. Join the conversation and become part of the elite community driving the future of global finance. Welcome to Elite Economics, where knowledge meets elite insight.